Hello, I'm Yutaka Watanabe, a tax accountant. This is the channel Tax Accountant Nabe solves your money problems. This time, I will talk about tax audit, transfer pricing taxation system. Corporate profits sometimes cross borders, almost like magic, and before you know it, they seem to quietly disappear somewhere. But of course, the government is not just standing by silently and watching. Behind this lies an extremely intense battle between companies' shrewd strategies and national tax rules. So, what kind of battle is actually taking place? Let's dive right into this fascinating world. First, let me start with the first mystery. How do multinational companies unfairly reduce tax across borders? Doesn't that make you curious? You sometimes hear news stories about very famous companies that should be earning massive profits in a certain country, yet somehow pay surprisingly little tax. And they are certainly not secretly stuffing cash into bags and smuggling it behind the scenes. They use a far more sophisticated and systematic method. From the outside, it looks like an ordinary business transaction, but in reality, profits are quietly moving across borders. The key to solving this mystery is hidden in today's theme, transfer pricing. Let's uncover how this mechanism works together. Chapter 1. Basic structure of the system. Just hearing the word transfer pricing taxation system may make it sound difficult, but this is not just a calculation rule. In one sentence, it is a very powerful defense system designed to prevent companies from intentionally shifting profits overseas and unfairly reducing taxes in Japan. It is wonderful for companies to expand their business globally. However, if taxes that should originally be paid in Japan are quietly reduced through intentional manipulation, the fund that supports our society becomes insufficient and the balance is disrupted. That is why this system plays the role of an ironclad goalkeeper, so to speak, protecting fairness in corporate taxation. What this rule pays particular attention to is not transaction between complete strangers. It is precisely transactions within the same corporate group. In other words, transactions between related parties, where rooms arise to intentionally manipulate profit. When goods or services are exchanged between a Japanese parent company and an overseas subsidiary, a major opportunity for tax avoidance can be hidden there. Please keep this point firmly in mindset. Chapter 2. Mechanism of transfer. Now, let's look closely at the specific mechanism by which companies intentionally manipulate prices. This is where we reveal the trick behind the magic of disappearing profit. Normally, when completely unrelated companies do business with each other, they use an appropriate market price. But what if the other party is your own overseas subsidiary? Because it is a related party, the company can set a convenient price on its own while completely ignoring the market price. For example, it may intentionally sell sometimes that should really be sold for 100 yen at a cheap price of 10 yen. Or conversely, it may buy sometimes for 1000 yen at an excessively high price. This intentional manipulation of price is where everything begins. In step 1, the price is manipulated. In step 2, profits are shifted to the overseas subsidiary. In step 3, the tax burden in Japan is unfairly reduced. By artificially distorting prices, profits are hidden overseas, and the company attempts to avoid Japanese taxes. This method, which appears legal at first glance, is considered one of the most difficult issues in the world of international taxation. It is a cleverly designed logic, but the government is not that lenient. Chapter 3: Penalties for improper conduct. If the tax authorities do not overlook this intentional price manipulation, a strict process awaits, leaving no room for excuse. First, in step 1, the transaction price is judged to be inappropriate. Next, in step 2, the domestic tax is recalculated. The correct tax amount is recalculated based on the standard of how much profit should have arisen in Japan if the company had truly conducted the transaction with a completely unrelated third party. And finally, step 3 is the correction of additional tax. Not only is the company required to pay the tax it tried to avoid, but it is also subject to heavy penalties. This is an extremely strict response. A company cannot simply say, "Sorry, we will now pay the amount we should have paid originally," and expect the matter to end there. There are additional penalties as the price for improperly trying to avoid taxes. This is a powerful message from the government. Conduct business at appropriate price, or you will end up paying an extremely heavy price. And these strict penalties function as the greatest deterrent under the transfer pricing taxation system. Finally, let me ask you one question. As long as companies continue to operate globally, will the cat and mouse game between companies' shrewd pricing strategies and governments protecting fair tax revenue never truly come to an end? Even with powerful weapon known as the transfer pricing taxation system, business is becoming increasingly complex across borders. The battle between new methods of profit shifting and rules designed to prevent them may continue for a long time to come. This time, I spoke under the title Tax Audit, Transfer Pricing Taxation System. For information on tax audit, please also visit website of Yutaka Watanabe, Tax Audit, Tax Accountant Office. I will continue to talk about topics related to money, so please subscribe to the channel. Tax Accountant Nabe solves your money problems.